and I'm unmuting you.
Great. Can you
Yes.
hear me?
Yeah, welcome back, Michelle. So you've done this drill before to share your screen. It's a little green box on your,
Yeah, I see share screen and I want to do this screen, right? You see a four chart screen
not
with
yet.
oh, no wonder because I have to
You
push
have to
share.
click it. Yeah, there you go.
There
All
you
right.
go. Can
All
you see
right.
it now?
We got you, Michelle. So,
Oh, excellent.
wow, you and I are market veterans.
Yes.
I've never traded a pandemic before.
Well, yeah, I guess if you want to use pandemic as a metaphor, we've all been around for that. But yeah, an
Yeah,
actual real one, no. And
yeah.
Keith and I have been watching Containment, the series, a little bit on
Oh,
Netflix, and yet, this is anything but containment. We haven't been
right.
able to contain anything, volatility, price levels, etc. So.
Art imitating life again.
Absolutely. And by the way, Erin go bra.
Yeah,
it's
yeah.
it's funny. In a happier time, there would be tons of happy St. Patty's Day messages, and I
Yeah,
haven't seen one.
not
So I
one.
just wanted to make sure I did a shout out there.
All right. Well, also there's besides St. Patty's Day being missing, so is the color green on our screens.
Yes.
So interesting. I'm wondering what you think here, specifically. That commodities, precious metals, also took it on the chin during this. So, why don't you just go ahead and tell us what you're thinking here and um, it's probably okay not to do anything in this environment, but what are your ideas in this historic time period we're trading in?
Okay. Well, and we can cover. There's three different areas here. So, and
Okay.
I call sort of the trifecta of junk. And one, of course, is the virus itself and the impact that's had. Two is what's happening with the oil market and the Saudis and the Russians having a bit of a price war here.
Right.
And then three is the central banks and the Federal Reserve role of this insane amount of liquidity that they're adding here to try to stop the bleed. Of course, what they're trying to stop is the bleed of the market, and we're still waiting for the stimulus, as other countries are already doing for people who are actually suffering through losing jobs, not being able to go to work, businesses, etc. So.
Yeah, the fiscal magic bullet.
Right. So, this is really another classic case where it almost seemed like we were lined up, Main Street, Wall Street. Now we're kind of back into that separation of Main Street, Wall Street. So we're going to focus on Wall Street here. But Main Street does come home to roost, and that's where the pandemic really became evident, is that, you can only manipulate markets so much. So here we are back into mega manipulation, and the thing is we have to lose the judgment because we're in the business to make money. And so a couple of things about SPY that are really interesting, and this is far from saying we've bottomed, but we certainly could see a bounce. It would not surprise me, given how robust all of the liquidity has been in terms of injecting into the market. From a technical standpoint, even if I didn't know that, we're looking at the SPY chart here. On each time frame, which would be the daily, the
Yeah.
weekly, and the monthly, there are reasons for support. I'm looking right here up at the weekly chart. Here is your 2018 low right here at 233.76. Yesterday's low was just a little bit above that at 230. Ooh, I can't even read it. That red is very hard to read. But anyway, it was about 235 yesterday, the low.
Okay.
So there you have it holding the low of the crash in December 2018. By the way, besides this and Qs, nothing else has, but it's important because SPY, of course, the 500, Fortune 500 companies, and these are the corporations that typically would buy back their stock. Number two, here, and I just noticed this morning when I was preparing to talk to you, this is a classic inverted hammer doji. And for those of you who don't know what that is, it's when it gets forced down to new lows and the opening and the closing prices are either virtually the same or close to the same. And very often that means the selling is starting to exhaust. I mean, considering how we've gone down 3,000 just yesterday and then the debacle that we had last last week, you know, it doesn't take a genius to figure out that maybe we have some exhaustion on the sell side temporarily. So what I would be looking for right now is, and you can see the bid here is 245.64, so we're already not gapping up, but we are certainly coming in higher than where we closed. And on the SPY, we closed at around oh, these prices are not, it's very hard to see these screens with this red. Why do they do that? But it was about 237, 239.
Yeah.
Okay, so we're going to come in at 245. So what does that mean? If, and I'm going to blow this up. Oh, wait, there's one more. Let me just leave that for 1 second and bring your attention up here to the monthly chart.
What's that moving average? The
This
turquoise?
is, okay, so this is the 80-month moving average.
Oh, that's right. I remember you use that.
Yes, I love this. I actually credit the Aiden sisters for.
Oh, gosh.
Yeah,
Another name
remember
from the
them?
past. Yeah.
Right. Well, they introduced us to the concept of the 80-month moving average. So 80 months, you know, you've got about 5-6 years worth of data. So basically what that is almost a full business cycle. So again, SPY has held it almost to the tick, as you can see with its drop yesterday. So that's why I'm anticipating this type of bounce right now, but it really wouldn't look so healthy to me. And let me blow this up a little bit. Until we get a close above this 260 level right here. That's what I'd like to see. Here's 260 right here. It would clear the move from a couple of days ago, Thursday. Here was, you know, the big covering that everybody got excited about on Friday. Right. So really you're talking about anywhere between 260, 270. And then, you know, we have to start thinking, okay, this maybe is more than just a technical bounce, maybe a better bounce. And what would be great, and this is why people ask me about phases all the time, is we're not in a bearish phase in the SPY because the 50 is still above the 200.
You need a cross.
You need a cross, exactly. It's happened in some instruments, but not in this one. And I'm going to focus on this one because obviously this is, you know, the biggest stocks.
The benchmark, yeah.
Yeah, so here we go. If this actually can get just a meager bounce and chop around for a while and kind of reduce in volatility, wouldn't that be nice? Then we might be able to give that time for the moving averages not only to move closer together, but for the price to get closer for a better risk short. That's possible. It's also possible that we get a much bigger bounce and we actually take out the moving averages and then have a fake out. But this is only, when I say a fake out, I don't think this market is running to new highs or anything. I'm just saying that it might capture in a lot of longs. People are very used to being long. Anybody who's been trading for the last 11 years, and then they get screwed because the selling comes back in. Either one of those scenarios, but what it doesn't seem to me today, although anything is possible, is that we're going to go lower, at least from breaking yesterday's low, at least for now. Now, that's just one instrument. You know what I love to watch. My granddaddy. This is the small caps. Very different picture. And this was the picture that started us and our models. Our alpha rotation models got out of SPY and Qs while they were making highs and got into bonds at that time. And the reason why was because using the metrics, we use very much a lot of the modern family here, you know, the Russells, the retail, etc. And this was telling a very different picture. This couldn't even get to 2018 highs, let alone make new highs in 2020. So now I had to go back. We well broke below the 2018 low. So I had to go back to 2016 and actually right here, this 2016 low was at 114. We broke through that. So I had to go back even further to find something analogous to where we are. And here, actually, the 2016 low was made in April, I believe. Wait, hold on, maybe that's, no, the 2016 low, I'm sorry, was made here in February of 2016 at 93.64. So we haven't quite gotten there, but we've certainly blown through everything else. So what does IWM have to do? It's going to have to convince us that it's excited about all this injection of liquidity as the S&P 500. And there's a really big fundamental reason why. This is the 2000 small cap manufacturing supply side stocks within the United States. This is the true measure of how happy the economy is going to be going forward or not. So a bounce in SPY and a bounce in Qs is expected. They have been the ones that have enjoyed corporate buybacks, and they're the ones who are really enjoying any kind of liquidity, zero rates, etc.
Financial engineering really didn't take place in the Russell stocks. They didn't play the same game with going to corporate debt markets and then buying back their stocks, or just
They
using all
can't
their
afford
cash.
to. They can't afford to. I mean, these companies, I mean, and this is the thing, is that these companies, a lot of these small cap companies are really struggling and could wind up in bankruptcy. With the liquidity that's coming in and the 50 billion going towards airlines, it still doesn't really hit the manufacturing sector of this economy that we need.
It's a great point, Michele.
And so I would say, you know, if you want to have some fun trading from the long side for a possible technical bounce, go ahead. But don't get married to the idea of a bullish position or a bullish stance. First of all, you've had, you know, massacre here, but
Yes.
you know, until this really shows us some kind of real strong volume buying that sustains for more than a day and a half. And that's really kind of what I'm watching for. And that would at least start with getting over last week's low, which was at 110. Basically, let's call it 110.
Okay.
If we can get a close above 110, if it's not today, if it's not tomorrow, yeah, maybe we can go back up to 125. Now look what's happening here with the moving averages. We showed you the SPY 50 and 200 still far apart. This is coming closer together. Now this would not be a sellable type of bear phase death cross, because look how far the price is. Your risk is just insane. But it would be really nice to see some kind of bounce and a better risk for a short. And so
Okay.
I really, and by the way, everybody's saying that the market's going to turn completely around if they find some kind of a cure or if the virus starts going away. There's still major inherent problems in this, and that's, people are forgetting about the oil. They're forgetting about the fact that the Modern Family and the Russells and retail and transportation and regional banks have not participated in this whole rally for a very long time.
Therefore, Michele, it wasn't really all about the coronavirus, that these things were setting up, like the repo market last fall with having problems with the Fed funds market. And maybe the corona was just the match that lit the fuse. And, you know, a lot of people, it's serious to be exposed and infected by the coronavirus, but what's important is what it has exposed rather than being exposed. It's exposed. The emperor has no clothes.
Excellently well said, Dale. Yeah, exactly what I would say in the exact
Okay.
same way. So now let's, oh, I'm so sorry. Hey,
That's
Raul, I hear
okay.
you. Yes, Raul is,
Hey,
I
hey,
didn't feed
buddy.
the, you know what, I usually feed the dogs at 7 o'clock, and I didn't feed them because I wanted to get in.
Yeah, I thought he was mad because I interrupted you, but
No,
go
he's mad
ahead.
because I'm not paying attention to him.
Okay.
Uh, all right, if you want to see something really sobering as well as what we just saw, so we saw the supply side,
Yeah.
which is the Russells. Here is the demand side. This is the transportation.
Yeah.
And of course, look what's happening here. This is, well, we don't know, it's a bid offer, it's, you know, and it's a very thin instrument, which is incredible to me how thin this is. But a couple of things to notice. Broke down, broke the business cycle. That is broken. Okay, that doesn't mean we can't rally, but it's broken.
Yeah.
Closed on the lows. This too, well below the 2018 low. Made a new low on the close yesterday, and in a
Never
bearish
made a
phase.
new high.
Oh, never.
Yeah,
Even
that
in this
was a
little,
weakness. Yeah.
yeah. So now, what is interesting with making a new low yesterday, if we saw a reversal, so what is a reversal? Would mean that we'd have to have great volume and a close over yesterday's high at 138.91. Okay, so that's another thing to look in mind. If you really want to make a case for a sustained bounce over than a day or two, then you must look at the Russells, as I showed you. 110 is really what you're going to look at, and you must look at the transportation. Very important that it closes, let's say, roll, stop.
It's okay. Just go ahead.
139 or better. Okay, so that's another one. Last one of the modern family, well, actually not the last one. This is retail. Now, what's really, really sad about retail is forget about 2018 low, forget about 2016 low. I had to go all the way back to 2012 to see the lows that we have seen in the retail space. This is massacre right here. So again, all of these things have to be watched. So I can't say it enough. That doesn't mean I'm saying don't buy and have a little fun on the bounce, but don't get into this idea of complacency from the bull side and think about any kind of bounce other than short term as a bigger sell opportunity. And finally, the instrument in my modern family, regional banks, that's really been hit by the whole oil thing is because they finance a lot of the oil and gas companies, is the regional banks, KRE.
Yeah. And
that too broke through a lot of stuff. Here's your 80 monthly. However, it did hold the 2016, or it's right around that 2016 low of 32.63. We're coming in higher there. So keep that number, 32.63, in mind. And again, if we're going to get any kind of reversal here, we have to start out with a close above yesterday's high at 34.50.
Okay, so the message being, look for some of the weak stuff to give you a positive signal, but your better long most likely is going to be in things like S&P because the break hasn't been as deep as some of these other massacred indexes.
Right, and here's the cues, which the SPY you saw landed right on the 80 month. This didn't even get close to that.
Yeah, I noticed that.
Yeah, another not quite perfect inverted hammer doji, but again, not a bad one. So we would be looking for a close somewhere over 180 to show that this really is going to have any kind of legs.
Okay.
Now,
so
you want to go to commodities?
Yeah, the ancillary markets now.
Okay, well, let's look at the bonds. So the bonds right now, actually, I think all things considered, with the little bounce here, the bonds are holding up pretty well. We caught the bounce in the bonds from really here all the way up into here, and we got out under 170 because it was, you know, a real topping type of pattern, and we haven't gotten back in yet. And when I say we, I'm talking about our quant model. And I like to use the quant model because it's based on all of the knowledge that Keith, Jeff, and I have accumulated, and James, over a combined 120 years. It uses that type of knowledge and the things that we look at, but it doesn't have the human emotion factor, obviously. And that's why it's done unbelievably well and has so outperformed the market. So right now we're out, but if we get another signal to come in, I think that would be a bad sign. So right now, the fact that we're out, that particular model, alpha rotations in cash, it'll be interesting to see what comes first. Entering any of the indices, because it's either in indices, SPY and Q, cash, or bonds, right?
Yeah.
So right now it's in cash. So that's telling, okay? So that's number one. We want to keep an eye on that. We also want to keep an eye on what's happening with the dollar, which all of a sudden, with all the money that's being printed, it's become almost a flight to safety situation. And look how strong the dollar is right now, which was something that I was completely wrong about. I will admit that. I thought the euro, it closed great. It closed above both moving averages, was ready to explode while the dollar would collapse. And just the opposite is happening here. This is actually going to come in right around 104, 103.80, 104. So the dollar is the reason why you're not getting any sustained rally in the gold, although it's holding the 50-week moving average. The silver got absolutely crunched. Look at that, pathetic. And that's actually even lower still. And then the miners, which tried to get some kind of really big move yesterday, might have a little bit of digestion. So again, I'm not saying I would not look at gold and miners. I would still look at them for a clue, because I still think, and I haven't seen anything that changed my mind yet, the Fed is fighting desperately against deflation. And of course, with oil, that's been a situation, and all the food prices low. But we've had issues now with this incredible amount of QE, with the rates at zero, with any kind of drop in the dollar, and the economy really basically going to a screeching halt, that stagflation possibility is still with me. And
Okay.
so I would look at the miners, because miners will tend to outperform before gold if the gold is going to get bullish. Yesterday, I put out on Twitter a day trade in gold, and I just made it a day trade. I got out at the end of the day. We bought it at 137. We got out at 140, and then 140, 150, and that was it. We called it a day. This is coming in lower now, but it's still in a strong trend. And if food, which is in a supply chain disruption in China and could happen here, and now we've got borders crossed with clothes in Canada, etc., and Mexico, where we get a lot of our food, I would also watch the DBA, which is the Agricultural Fund for all of the wheat, corn, soybeans, etc. And if this can get a close of 1405 or better, and I mean a close, and even ideally a weekly close, because I'm showing you right now the weekly chart, then you have a nice little risk underneath the low here at 1350 to see if the dollar starts to come off and food supplies start to really wane, and considering how much food has been bought by people throughout the world and in this country, then that could be interesting as well.
How far back do you have to go on DBA? I know it's probably only been around for about 5-10 years, but are these new lows for a long time?
Yeah, let me take a look here. Well, let's get the monthly chart that's going to give us the most amount of information.
Okay, yeah.
DBA looks like it started. Yeah, it started in like 07.
Okay,
so
and these are
yeah,
new lows.
these are new lows. Absolutely, these are new lows, right? So this is where the deflation is coming out. But the Fed and the central banks are doing everything in their power to try to stop that. So that's a positive on the one hand, and on the other hand, I'm waiting. It hasn't happened yet, but I still think that this could backfire, or the old "be careful what you wish for," and turn out to be more of a stagflationary situation, which the liquidity that they added we haven't seen since the mid-70s. And guess what? Mid-70s is when we went into stagflation.
Yeah, so let me ask you this, though, Michelle. Monetary policy has a very long lag time. And, we may be seeing the tail end of QT. And that may be part of the reason for the impact of falling markets. And maybe it takes 6 months or so for everything the Fed is doing now to start to have some impact.
Oh, it's very possible.
What do you think lag time is on Fed policy? People have different opinions.
Well, just let's go in history here. 2008, when they first did the injection in 2008, the market did not bottom until the spring of 2009.
Okay, right, a year.
Almost a year. It was a little less than a year. So it was like 8 months. So 6 to 8 months. And that was in a situation, though, that was very different, because we were talking about a mortgage debacle that mainly was in the United States. And the Fed had a lot of tools at that point because the rates were in zero.
Great point.
This is a very different scenario right now, because this is now not just affecting the United States. I mean, there was some global fallout, obviously, during 2008, but this is the whole world, with economies shut down, with the Philippines closing down their market. I mean, this impact really is not going to be a question of how long is it going to take for all this injection to come into the market, but really, to me, it's going to be more of a case of what happens if this doesn't help.
Yeah, Fed, less tools, hope for a vaccine. I mean, I've read articles that because of the mutation of the virus, it's going to be a very difficult endeavor to get a vaccine. What are you and Keith and your family doing? If you want to talk about other markets, that's fine, but what are you doing personally during this crisis? Not social distancing, but physical distancing. And are you and Keith Rob and Laura Petrie in the Dick Van Dyke Show, sleeping in separate beds?
No, no, we're more like, the Titanic. We want to go down together in the ship.
All right. Anyway, look, I didn't plan to say that. I just can't help myself. But are you doing anything special? Are you staying indoors or?
Well, yeah, I mean, we are we both love going to the gym, so we haven't been going to the gym, which is
Yeah,
driving me insane. So because I
yeah,
love,
yeah,
and also we're not eating out in restaurants. But Santa Fe is a little bit different than the rest of the country. It's actually a really good place to be right now
yeah,
because of the fact that we have a dry climate. So we've
yeah.
had 21 cases as of yesterday in New Mexico. Um, and
Mainly
so,
Albuquerque.
right, and the shelves
Yeah.
weren't. Bernalillo in Albuquerque, and the shelves
Oh,
have not been picked clean. I went to Trader Joe's on Sunday, and there was no pasta, no beans,
yeah,
no that kind of stuff. But there was tons of produce and goods. So we're feeling almost like in a little bit of bubble here. So we're just being careful. No restaurants, no gym. We
yeah,
haven't gone out to socialize. I haven't like done things like go get my nails done.
yeah. Are you getting any kind of like very big macro message? Are you worried about this? That perhaps because the Fed is out of tools, that maybe we could get at least maybe another year or two hurrah out of this. But uh, we're fortunate. We could make a living being inside at our workstation and trading. Um, what do you think the longer term implications are for the
In terms of
economy?
mega trends,
Yeah,
yeah, oh yeah, no, I think this definitely is going to have some. Well, there's two things. Humans have very short memories, so there's that. But there's also the idea there will be some permanent changes, and I think people who can work more remotely will. And I think that's going to be the biggest impact. Is that people? But I do think that we're social animals, and
yeah,
once this passes, everything will go back pretty much to normal, except for maybe a lot of businesses that may really suffer and go out of business here. Remember, most people a year ago when the economy was booming couldn't put $400 together in an emergency. What's going to happen now? So, it's going to be interesting. Again, what's going to happen? How far is the Main Street impact in these small businesses and these manufacturing companies going to have a long-term impact, regardless of whether the banks buy back their own stocks, which they said they weren't going to do, but all these other banks were allowed to finally borrow money from the Fed.
yeah,
So it's really, I don't know exactly
yeah,
yet, but I
yeah.
wanted to show you one last chart before we
Go
say
ahead.
bye-bye,
Okay, okay.
because this is really important chart
Junk
right here.
bonds?
This is not junk. These are
Okay.
high yield. This is
Wow.
high grade
I agree.
investment bonds. This represents the biggest companies, okay, right here.
Yeah.
Intel, General Electric. I have a list in one of my recent blogs of the stocks. So last week, before we saw what was just happening recently, and the fact that they're looking for another, what is it, 850 billion in stimulus, et cetera, et cetera. Last week, the Fed gave money to the banks to buy this instrument right here, to buy high grade debt, okay? And with that, that's why you saw this big move and then the close strong on Friday. That was that first announcement
Okay.
of that they were doing that. And yet it took me a while to dig down to see it wasn't the Fed themselves buying, but they were giving the money to the banks to buy. So here we are, the top companies with the highest grade yields. If this cannot move, and look, it's down on the day, you have a 200-week moving average right here.
Yeah.
If we can't get back over the 200-week, and here we've been below the 80-month before, but now we're sitting right on the 80-month. And of course, so far we're just having an inside day. I would say if you really want to see what the corporation's appetite and banks' appetite is for risk and whether or not the injection of liquidity does anything for them, it's really that simple. You can just look right here.
LQD. What a great presentation.
Oh, thank you, Dale.
Thank you so much, Michelle. I mean, uh, it's great to have someone that has lived through different cycles, give their perspective, and I'm getting pretty much a takeaway. Be prepared for a bounce. Don't think the bounce is going to carry us to new highs. And this last chart is really key because if investment grade debt
Yes.
is getting downgraded and ends up being junk, we really have problems.
We really have problems. Yeah, yeah. And
Credit markets are really something to watch during this whole scenario.
this is a credit crisis. I mean, this is really, let's just call it what it is. It's a credit crisis. And whether or not that can be abated with the injection of liquidity remains to be seen. Now, the last thing I would say is I was on the floor. Well, I was on the floor for many years, but I was on the floor on October 19th, 1987.
Yeah.
Which kind of was very similar. I mean, we had the huge crash like we saw yesterday.
Mm-hmm.
Rates, of course, were much higher at that particular point, which was part of the problem. Nothing like what we're seeing now. But it took about a year for the market to come back. So in that time frame, you know, we talked about maybe 8 months like we saw in 2008. But if we go back in time, it took even longer at that point.
Yeah.
So we'll see. We'll see.
Yeah. Market had a car wreck and now it's in shock and then has to heal.
Yes, exactly. And right now this this LQD is going actually south, and that concerns me. So those of you listening who are thinking, oh, this is a great buy opportunity, be careful.
Okay, Michele, why don't you show your website so people could follow you or work with you?
Oh, absolutely. Let me go to Market Gauge here and put that up for you guys. Well, yeah, we've been really doing great. I mean, like for example, our NASDAQ model is long Regeneron. You know, we were long the bonds in our alpha rotation model. We're short a couple of instruments and took some profits yesterday in another one of our models. So our quant models are doing great. Here's our website, marketgauge.com. You know, I write my daily blog here. Keith does a weekly one. These are all free. And then, you know, we have a lot of different information all around if you want to take a look at our products and services. And then I do education and discretionary trading model as well, which, you know, we did very well in the bonds and now we're basically almost 99% in cash waiting to see if it's time to go short again or looking for some kind of buy opportunity if that pans out.
Okay, well, you could follow Michele at Market Minute on Twitter, and her website is marketgauge.com. She's a pro, and as you could tell, she's been here a few times and some great ideas. Thank you for edifying the F.A.C.E community in the middle of all this turmoil, Michele. Thank you.
Oh, thank you, Dale. Thank you for constantly inviting me back. I really appreciate it.
All right.
By the way, Granddad Russell is now red. Just mentioning.
All right.
Okay.
Okay. Thank you, Michele.
Good luck, everybody.
Yeah, everyone, good luck. Getting the pop in Kiwi and Aussie on the Turnaround Tuesday trade. And good luck, everybody. Remember, don't just count your pips, count your blessings. And we'll see everyone tomorrow. Thanks again, Michele.
All right. You take care, Dale.
Bye-bye.
Bye.